All right, ladies and gentlemen, I hope you had a wonderful weekend. We are about to start the craziest trading week of the summer. Not only do we have earnings, not only do we have Powell, but it is the end of the month, and we are about to experience either the first down July in 10 years, or these next couple of days is going to bring us right back to being green. Then we got to deal with August seasonality, but then on Friday, we have the jobs report, and depending on how that goes, it is going to confirm or deny whether or not we bounce, or if we're about to start seeing a lot of downside volatility. So we got a lot to talk about. There's a bunch of different events, both here and overseas. I have that recap. I have the plays. I told you there's a bunch of earnings and a lot more going on this week. We're going to cover all of that. What I need from you, a thumbs up on the video. Make sure you're subscribed, and if you don't know, we are live Monday through Friday, 30 minutes before open, youtube.com/the stock market. We will see you there in the morning, baby. Run it.
Working to the couch, it's the 2020 election. Live in the hills, but I still get a spread. Started with a live, but I still reinvest it. Fear how I feel, then you feel like a blessing. I just want the lesson, I just want protection. I'm up and I'm down, but they sound like progression. Farmer never plans if he waits for perfection. Finger to the down.
Right off the bat, don't forget, today is Sunday, tomorrow is Monday. You need to post a random play in the comments, but also don't forget what happened last week. We had all of the earnings. The earnings themes were not that good to start us off. People were getting worried about the AI bubble popping. You had one of your biggest down days in 2 years, and even the yen and a lot of things overseas were going crazy. And then on top of all of that, you had that rapid steepening of the yield curve, and people were asking, what is this going to mean next? So that's what gave us this little setup here. But before I get into any of the keys and all of that, we have to talk about that seasonality stuff, because I've been telling you, you literally have not had a negative July in 10 years. But here is the point. Don't get lost in the sauce. It don't matter who is the president and all of that stuff. What I want you to realize is that June 28th, you are literally right here, right now. That's exactly where you are yesterday or Friday. So this is such a big deal, because that means whether we go green or red on the month will be determined by these next 3 days, Monday, Tuesday, Wednesday. If those days are good and give us an advance, July is going to be green. If those days give us a decline, then July is going to be red. That means to set up this month in this end of the day move, we have seen this a lot more last year, where the end of the months were pretty much defined by 3 days. This just means we have a lot in store for these next couple of days. So I wanted to start off with that. Definitely don't forget that. And the best part is we start August by the time this week ends. And if you're not familiar, the first week or two of August is also one of the worst weeks seasonally speaking. So keep all of that in mind. But now to get into the keys, like I'm telling you, man, this is probably going to be one of the biggest weeks of the summer, at least up until the SEP in September. So I'm not saying September is going to be big. Don't forget the summary of economic projections that is released quarterly from the Fed, and we do have a Fed meeting this week. It's not going to contain that. So the way I'm looking at it, this is going to be our checkpoint up until then. And if we are going to continue the volatility, if we are going to get a bounce, I think the data, the earnings, and everything we're going to get this week, that is going to define everything. Now, I'm going to take this line here from Bank of America. Michael Hartnett was talking about it, but the fact is, not only do we have earnings, not only do we have Powell, not only are we wrapping up this July with a lot of history on the line, but you also get that jobs report. And I hope you have realized there has been a lot of things going on, both above and beneath the surface. And the way a lot of people are looking at things right now, we are one bad payroll away from everything turning sour. Think about all the volatility that we've had so far. It's not like you are down on the quarter. Believe it or not, I think you are still up about 8% since the last earnings around April. So you got a really, really good gain. And even though we have declined in the last 2 weeks, we're pretty ugly, there is still a lot more room to give up. And what I'm trying to say is that the market has been very resilient. The only way this turns around, if Powell is either neutral or not favorable, but then we get more volatility and you finally get that crack in the jobs market, that's when things are going to turn around and get really bad. Remember, whether it's the yield curve, the Fed, a lot of the economists, everybody is looking for that rapid weakening in the job market. That will derail or confirm your soft landing, no landing conspiracy theories. So if we do get that this week, if we have a bad payroll, that will literally put the nail in the coffin for everything that we've witnessed over these last couple weeks. But also, to the contrary, if we do get a good payroll, that might help us punt a little bit and clear the road until we get the earnings and then the SEP coming in about a month and a half. So keep this in mind. Like I'm saying, you look at the calendar, everything we got going on, this is about to be a huge week. And on top of it, I don't know if you guys have noticed yet, but the last 2 weeks, you have literally watched the most crowded trades all get sold off. This is once again what Bank of America and Michael Hartnett said over the weekend, but all you have to do is look and you'll see it. Chip stocks, the AI trade, the big tech, the whole short yen, long copper, a lot of the major themes of this year, even some of the major themes for the last half of last year, they all started to unwind on some of this volatility. And what I want you to realize is that this is a tectonic plate. If any of these big things stop behaving like that, if the yen starts rallying for the whole second half of this year, if big tech starts coming down and the AI trade does not get steam from earnings and all of that, that will be a huge shift that we have not dealt with in at least a year. So you got to keep your eyes out for this, because this is what we've been dealing with as the volatility has slowly been ticking up one sector at a time. The whole idea is these crowded trades where everybody's been going to get safety, the whole market cap, and how everything's been concentrated, you have been slowly watching an unwind, and that's what we have to watch for this week, whether it's the payrolls, Powell, or earnings. Does that lead to the crowded trades getting unwound, or do they regain their dominance again? I think that is going to be a huge and major theme, so watch out for that. And then finally, man, I just got to put it here, bro. It is a huge week. Everything that we have, man, what you're going to be dealing with, just even in writing, in words, simply broken down into events, this should highlight how big this week is going to be. You're going to get earnings, you're going to get Powell, and then even overseas, I think Germany, Spain, France and Macron, you're going to be getting a bunch of global CPIs, a lot of global data is coming out. We're even going to get PMIs and manufacturing data. I'm telling you, JOLTS on Tuesday, the whole calendar leading throughout, it is about to be massive, and this is what is going to sum us up for the end of the month and the beginning of a new one. So I hope you're ready. But now, let us get into the plays. So, right off the bat, I do have a couple of plays. And actually, no, before I get into that, I got good plays. Let's go with the question. We need to talk about this because, like I'm saying, in the context of everything going on, what's going to happen, what we're going to get with the data, you do have Powell on Wednesday. And even though we are expecting him not really to move, a lot of people are asking this question of whether or not he is going to cut on Wednesday. So the easy answer is no. He should not do anything. But if he did, something big just snapped. And why I'm bringing this up, there was some former Fed chairs over the last week or so, literally last week, saying that Powell should be cutting right away. And even on top of that, if you noticed what happened last week in China, they weren't supposed to cut their rates, and then they surprised everybody. So we'll see where this data goes and what it brings, but the problem is all of the big data that could change the rate cut odds, it comes after Powell. So he shouldn't do much, and if you aren't aware, and this is why I'm saying, yes, Powell will be key, he shouldn't do much, but this whole debate now, it's all about what happens in September. That is going to be the first rate cut, if anything. If you want an early rate cut, that's where people are looking for. If you think the rate cut's going to happen before the election, September is going to be the date. So although it may seem like this doesn't give you anything to really trade off till then, to the contrary, pay attention to what Powell says this Wednesday, because people are going to be looking out for how he starts to telegraph September or not. The data will follow it up on Friday with the jobs, and we'll see where that takes us. But in theory, Powell shouldn't be cutting on Wednesday unless something really big just broke, like maybe some stuff we've seen overseas. But on Wednesday, Powell should outline the plan, or at least hint at whether or not he's going to do September, especially if the odds for September are increasing with the data. So even without it, it should be a wild week. Don't get too jumpy. Oh my gosh, Powell's going to do all this, but we'll see where it all takes us. So had to throw that one in there. But now, getting into the plays, I got to start with the first one, Meta and NVIDIA. NVIDIA does not have earnings this week, but Meta does, alongside Apple, Amazon, Microsoft, and even a couple. I think I'm missing one more. There's literally a ton of earnings, but tomorrow, Monday, you have a fireside chat with Mr. Jensen and Mr. Zuckerberg. Mr. Zuckerberg, he's been looking great. Honestly, he looks like such a bro. I got to call him with like Broberg or something, you know what I'm saying? Because like he's been looking good, but the whole idea here is there is going to be pre-earnings plays here on both Meta and NVIDIA. Meta is right around the corner. He's going to have this event here with Jensen and NVIDIA. Maybe they bring up something big. If you saw last week or literally coming into Friday, Saturday, that crypto event caused a big move. So maybe we get the same thing here, but also remember one of the bigger themes here, people are getting worried about that AI trade. That most crowded trade has been unwinding a little bit. Let's see if this brings any steam and gets some things running. So watch out for that. That is play number 1. Then play number 2, Airbnb Habibi. So this one, I just went with the pre-earnings on Friday, and believe it or not, I'm not too sure how I feel about travel trends this quarter. I do think travel is good, and even the last earnings, and this is where I'm kind of worried, because even the last earnings where people thought travel really wouldn't do the best, it found a way to do good. So I feel like the bar is kind of high already, even if you've been paying attention to the Olympics and some of those trends, like right before the Olympics, a lot of the prices for lodging literally plummeted. Even on the CPI, the lodging away from home, that also dropped as well. So I'm kind of uncertain on what's going to happen in terms of trends. I do like Airbnb. We haven't bought it for the long term in a minute, so maybe a bad earnings will open up that door. But I did decide to go with a pre-earnings trade simply because the last 3 days, it absolutely killed the stock. So it's been going back and forth, but I think it did this kind of ahead of the other earnings, just not for 3 or 4 days. So I did decide to go with the August 16th 170 call. I grabbed 5 of them for 52 cents, and really my idea is the other half of the earnings start this week. Even though Airbnb is the next week, I was like, man, these are down 70%. I'm going to go with the pre-run up play. If any of the other names could get this boost up and we make it free ahead of time, that would be the best win so far. So that's what I'm going to be looking for. And even on top of that, don't forget this is your earnings calendar. So it is a packed schedule. Everything from Apple, even McDonald's, we're going to wake up to AMD, Microsoft, Starbucks, Meta, Boeing, Amazon, Apple, Intel, Coinbase, the oil companies. It is going to be absolutely crazy. So pre-earnings plays, post-earnings plays, you guys are even familiar with the 2 standard deviations. If you didn't know, we killed it. We hit literally 2,000 percenters on 3M last week using the same ghetto standard deviation strategy. I think it's in the description of this video, how to price options. So don't forget about that, because ahead of earnings, that's always going to be the best strategy. And then even afterwards, those post-earnings continuations, there is going to be a lot of opportunity. So keep that in mind. And even then, word to the Airbnb play, we will have booking on Thursday. So even though we're early on it, we will have a sympathy ahead of time, and then we'll see where that one takes us. But that is play number 2. Watch out for that. And then finally, play number 3, baby, Pfizer. So they're going to be having earnings this week. And believe it or not, in a very weird way, this stock reminds me of 3M. 3M was crazy, and we had that, and you're like, wait a minute, Pfizer and 3M are nothing alike. 3M did not mandate that you wore a Post-it note. You know what I'm saying? I get it, but in general, we made these plays around the same time. Remember, we have 3M in the long term. We even played it here on the earnings, but the whole idea with 3M, it was one of these bigger value plays. They finally turned it around. It did come as the result of a new CEO and other things, and even a spinoff and a dividend cut, but finally they start to took off. So what I'm looking for, Pfizer, if they could actually show a good turnaround in earnings, I think there's going to be a lot of upside, and we already have exposure. I do have those free options from about a week or 2 ago. We have it in the long term, but now here's where it gets good. I brought this one up on Friday. They have earnings here on the 30th, but if you guys did not notice, remember, we played Pfizer. We had that lead up. That's how we got those free contracts. It was all related to the ex-dividend, and their ex-dividend was about 2 days ago, but you'll notice the stock didn't go down and they went up. So not only if you played the ex-dividend, you got to make money off of it, but now coming into the earnings, they're brushing off a lot of things. They got the rotation and this turnaround stuff in their favor. All they need is the actual numbers to show it. Then I think it's going to be a big time, and I think this thing should break above 2 standard deviations if they could come in with an earnings that shows turnaround. If it's the same story, they're probably going to get relegated back to the gulag. So we'll see how it all plays out. Should be a good time. But Chattadonia, I think that's it, man. Yeah, those are all of the plays. And now we do have an economic lesson. I only have half of one of the sections because it's really, really long here. So we're going to keep that going. If you guys are not familiar, we have been throwing some random economic lessons at the end of the watch list. We've actually covered about 200 pages now into a textbook. If you go to this channel, it's right there. There's an econ lesson playlist. You could catch up with all of it. And right now, I think we're on chapter 9 of International Political Economy by Thomas Oatley. And we are still going over multinational corporations. So like I've told you, I've even been sharing with you some of my own political bias as of late as it comes down to the book here. If you do see me interrupt and I'm not reading, that is my opinion. It will be prone to bias, regardless of what I believe or not. The thing I've always liked about this book, it gives you a good look at both sides. It's never been one of those that kind of just like gives you propaganda, and I always loved it, and I think some of you have too, how it covers both sides. So we're going to continue here on MNCs and talk a little bit about how they have been regulated. So, the international regulation of multinational corporations. There is no multilateral regime governing FDI and the activities of MNCs. Governments have tried to create multilateral regimes on multiple occasions since 1945, but these efforts have yielded little because conflict between the capital exporting countries and the capital importing countries have prevented agreement on such rules. Developing countries have advocated of international rules that codify their right to control foreign firms operating within their borders. Advanced industrialized countries have pursued rules that protect foreign investment by limiting how countries can regulate MNC affiliates operating in their economies. Given the divergent goals, and agreement on a multilateral regime has proved impossible because of the impasse on multilateral rules. Capital exporting states have protected their firms' overseas investments by negotiating thousands of bilateral investment treaties with host governments. The BIT-based approach has generated a global FDI regime that is not only decentralized but also highly asymmetric, that is biased towards the interest of capital exporting economies. Historically, international rules governing FDI have been based on 4 legal principles. First, foreign investments are private property to be treated at least as favorably as domestic private property. Second, governments have a right to expropriate foreign investments, but only for a public purpose. Third, when a government does expropriate a foreign investment, it must compensate the owner for the full value of the expropriated property, or in a legal terminology, compensation must be adequate, effective, and prompt. Finally, foreign investors have the right to appeal to their home country in the event of a dispute with the host country. Although such principles are designed to protect the proprietary or the property of foreign investors and therefore clearly reflect the interest of the capital exporting countries, capital exporting and capital importing countries alike accepted them throughout the 19th century. The one exception came from Latin American governments' challenge to the right of foreign governments to intervene in host countries in support of their firms. By the late 19th century, Latin American governments were invoking the Calvo Doctrine, named after the Argentinian legal scholar Carlos Calvo, who first stated it in 1868, which argues that no government has the right to intervene in another country to enforce its citizens' private claims. The capital importing countries began to challenge these legal principles more intensively following World War I. The first challenge came to the Soviet Union, where the 1970 revolution brought to power a Marxist-Leninist government that rejected the idea of private property. So I'm going to interrupt here. We're going to go talk a little bit about World War I and all of that, but hopefully you're understanding what's going on here. Even the Calvo Doctrine is saying that, yeah, countries can't be going in to other governments and saying, oh, you have to enforce these private claims. And again, think about treating other companies and MNCs and what they're doing as private property. The whole Calvo Doctrine is saying that, well, it may be your property, but who's going to enforce it? Because these other countries, another country does not have the right to go into a different country to try to enforce a private property claim. And that's what this whole chapter is about, is saying how do we actually have a mechanism where you could enforce these rights as everybody is doing these cross-border investments and all of that. So Continuing, the comprehensive nationalization of industry that followed constituted the most significant attack ever waged on foreign capital and radically redefined the role of government in the economy. Some Latin American governments also began to expropriate foreign investments during this period, particularly in the extractive industries and public utilities. These acts broadened the notion of public purpose that stood behind the international recognized right of expropriation, extending it from the traditional association with eminent domain to a much wider association with the state's role in the process of economic development. In addition, such widespread nationalizations posed a challenge to the principle of compensation. The Soviet government linked compensation of foreign investors, for example, to claims on Western governments for damages caused by their militaries during the civil war that followed the revolution. So hopefully you're getting what's going on here. It's just talking about how this idea of the Calvo doctrine and saying that, well, you can't enforce all of this, it led to a wave of nationalizations, and then everything from how you can nationalize, even the compensation fact with the Soviets. This one's interesting because it kind of relates to what's going on now. Imagine all of the little stuff we do with Ukraine and saying we got to pay this back or we're going to take these assets and all of that. We did something similar back in the day, not as extreme, but even the Soviets, they were saying, oh, well, we're going to nationalize this stuff and it's part of what you owe us because of the war and all of that, which again, this is just explaining how everything got difficult in the aspect of trying to regulate all of this. So continuing, the United States attempted to reestablish the traditional legal bias for investment protection following World War II. As the largest and in the immediate post-war period, only capital exporting countries, the United States had a clear interest in establishing multilateral rules that secured American overseas investments. But U.S. efforts to achieve this goal by incorporating the historical legal principles in the International Trade Organization ran into opposition from the capital importing countries. Governments from Latin America, India, and Australia were able to create a final set of articles that elaborated the right of host countries to regulate foreign investments within their borders, but provided little of the security that American businesses were seeking. Consequently, American businesses strongly opposed the ITO's investment components, as the U.S. National Foreign Trade Council commended the investment article not only affords no protection for foreign investments to the U.S., but it would leave them with less protection than they now enjoy. Oppositions to the investment articles from American businesses proved a major reason for the ITO's failure to gain congressional support. So again, they tried away this ITO and they're like, yeah, let's do this. Let's try to regulate again, even following World War II as everybody proliferated in their investments and getting into that post-war economy. But even then, it wasn't protecting these businesses. It never really got that much traction. So continuing, the ITO experience is important for two reasons. First, the failure of the ITO meant that there would be no multilateral regime governing FDI. Second, more broadly, the failure of the ITO reflected a basic conflict that has dominated the international discussion about rules regulating FDI to this day. Capital exporting countries have pursued rules that regulate host country behavior in order to protect the interest of their MNCs. Capital importing countries have pursued rules that regulate the behavior of the MNCs so that they can maintain control over their national economies. The basic conflict has prevailed for more than 70 years on discussions about international investment rules. So I'm going to stop again, but think about it. The challenges that this is all showing to try to find a way to make everybody and regulate it between parties, it's bringing up this whole debate we were just talking about of, well, how do you attract the FDI without giving up foreign control, or how do you maintain your foreign control while at the same time drawing in an ample amount of FDI so that you can grow? It is borderline the same thing here, and you can see how that one problem stems into many different facets. So continuing, during the 60s and 70s, developing countries largely set the agenda for international discussions about FDI. Working through the United Nations, the developing countries sought to create international investment rules that reflected their interest in capital importers. The effort to regulate MNCs became a central element of the new international economic order, under which developing countries sought two broad objectives that were designed to maximize the contributions of MNCs to the economic and social development of the countries in which they operate. To this end, states passed the United Nations Resolution on Permanent Sovereignty over Natural Resources in 1962. This resolution recognized the right of host countries to exercise full control over their natural resources and over the foreign firms operating within their borders extracting those resources. The resolution affirmed the right of the host country governments to expropriate foreign investments and to determine the appropriate compensation. Developing countries also sought to write a code of conduct that would ensure that MNC activities were compatible with the medium and long-term needs of the government in capital importing countries that they had identified in their development plans. The developing countries' efforts to write a code of conduct for MNCs met opposition from the advanced industrialized countries. Although the developing countries wanted the code to be binding, the advanced industrialized countries pushed for a voluntary code. In addition, although the developing countries wanted to regulate only MNCs, the capital exporting governments insisted that any code that regulated MNC behavior be accompanied by a code that regulated the behavior of the host countries. Governments worked on both codes throughout the late 1970s and early 1980s, completing drafts of both 1982. The codes remained in limbo for 10 years until finally in 1999 a UN committee recommended that governments seek an alternative approach. So hopefully you're getting a couple things, but the UN said, hey, we want to do this thing where if you have natural resources, you have exclusive control over that, and if any foreign corporation is messing with that, you have control over them and you get to determine all of that. And this is the code of conduct for all of these MNCs and host countries. And then the countries that benefit off of it are like, yeah, we love this. This is great. And then some of those advanced industrialized countries were like, well, wait a minute. Why don't we just make a code of conduct that's like voluntary, not like forced? You know, it's kind of like we all agree on it. And then they spent about like 10, 20 years arguing. Imagine the first UN resolution was in 1962. Then they argue on these code of conducts from the 70s to 80s. And then it wasn't until 1992 where they were like, you know what? Yeah, let's maybe see if we could figure out a different approach to all of this. So continuing, in the early 1980s, the bargaining power of international negotiations shifted back towards advanced industrialized countries. The capital exporting countries used this advantage to shift the agenda back towards regulation around host country behavior. Some initial steps were taken during the Uruguay round. Under pressure from the United States, trade-related investment measures, TRIMs, were placed on the agenda. A trade-related investment measure is a government policy towards FDI or MNCs that has an impact on the country's imports or exports. For example, domestic content or trade balancing requirements force firms to import fewer inputs or export more output than they would have without such government-imposed requirements. Consequently, such requirements distort international trade. In placing TRIMs on the GATT agenda, the United States sought to limit the ability of host countries to use such measures. Developing countries were reluctant to incorporate TRIMs into the GATT, arguing that development considerations outweighed whatever adverse trade effects TRIMs might have. Not surprisingly, these differing views made it difficult to reach agreement on TRIMs within the GATT. Failure in the GATT led to the principal capital exporting countries to pursue multilateral agreement on investments, MAIs, among the OECD members. The OECD appeared to offer at least three advantages because the OECD was comprised primarily of advanced industrialized countries, all of which shared a commitment in principle to liberal investment rules. Negotiations in the OECD seem more likely to produce agreement. Moreover, because most FDI takes place between advanced industrialized countries, an agreement among OECD members would regulate the majority of international investment. Finally, the OECD-based agreement would not preclude participation by developing countries. Non-OECD governments could accede if they desired. Governments intended the MAI to liberalize FDI to provide greater security to MNCs. Liberalization was to be achieved by basing the agreement on national treatment and MFN. National treatment would require states to treat foreign-owned firms operating in their economy no differently than domestic firms. The MFN clause would oblige states to treat their foreign firms from each party to the agreement on the same terms it accorded to the firms from all other parties of the agreement. To provide greater security to foreign investments, the agreement incorporated the historical standard of prompt, effective, and adequate compensation in cases of expropriation. In addition, the draft agreement restricted the ability of governments to limit the ability of firms to remit profits, dividends, and proceeds from the sale of assets. The agreement was also to provide a dispute settlement mechanism patterned on NAFTA, which would allow for both state-to-state claims and firm-to-state claims. Government failed to reach a final agreement on the MAI, however, due to disagreements among OECD governments and to a strong and vocal opposition of groups inside. By 1997, OECD governments had attached several hundred pages of exceptions to the general obligations they had established. The United States pressed to include labor and environmental standards outside the negotiations. A coalition of strange strange bedfellows arose in opposition to the treaty, including the AFL-CIO, Amnesty International, Australian Conservation Fund, Friends of the Earth, Public Citizen, Sierra Club, Third World Network, United Steelworkers, Western Governors, and World Development. In all, some 600 organizations in almost 70 countries spoke out against the proposed treaty. The combination of conflict among OECD governments about the specific content of the treaty and public opposition proved fatal. Negotiations ceased in December 1998 without a final agreement. So hopefully you guys are seeing, we're going to end it here because there's like a lot of this, but it's kind of going back to this whole WTO stuff. Remember the whole trade and how we had to figure out all of the WTO stuff in all those rounds? Well, yeah, it's the same thing here, but these are now with corporations and the idea of a host country versus the MNC, and then the capital importing and the advanced countries versus the capital exporting, and it led to this whole back and forth. We're going to go over a lot more of it, but the point you have to realize is how tricky this part really is. So imagine WTO and trade between governments. That's one thing, and that's already a difficult task, but just as slow and just as hard to figure out, if not worse. This whole MNC and host countries and this link between MNCs, there was a lot of politics and a lot of trouble finding a regulation mechanism that worked for everybody. And then even throughout the years, it was always getting challenged. And then the moment they figured something out, other people would add exceptions to it, and then before you know it, there was a lot of people opposing it because it was hard to really please everybody when it came down to importing and exporting capital and jobs and building out economies in all of these countries and working with these multinational corporations. So we have a lot more to cover. It's still pretty long, but the chapter is almost done, my friends, and now that is all I have. Get ready for a wild week, but that is your watch list, ladies and gentlemen. Make sure Hydra Healthy ready to go. Make sure post your watch list. Make sure we see you there in the morning. I need the armor on. I need the helmet shining, and I need you to remember there's a difference between belief and validation, baby. Don't ever forget that, but Chad, drink that water, stay hydrated, healthy, all that good stuff. I'll see you in the morning, and on.